All right. I hope everybody is doing well today. I am uh, getting the live feed started. As you are joining us, please use the chat box inside of the Zoom platform and type in there. Before you type in and press submit, make sure you change it from I think it says just all panelists to all panelists and attendees. We're underneath the to field, and then type in there so everybody knows as you're on here where you're from, where you're located, and make sure that you tell me that the sounds okay as well. We have a few more minutes till we get started on this webinar. I have a few more people that are a lot more people that are going to be joining us. So as you're jumping on, go ahead and type in there and tell us where you are, where you're located, and give me a thumbs up or a sounds great for the sound. So I got Kenneth Hayes on there from Atlanta saying that the sound is coming in okay. We're doing great. And then I have Evan McCune from Huntsville, Alabama. Thank you for joining us, Kenneth and Evan. And I also see on there Dan Perez and Carlos Daza, Ethan, have Kevin on there. We mentioned Linda and Mitch earlier, and Ajit Prasad. Thank you guys for joining us. I've got Mitch coming in there from Houston. That's great. And got Linda from Brooklyn. So we got all parts of the country on with us right now. That's awesome. And I'm, just so you guys know, I'm located here in Columbia, South Carolina. And everybody has always been asking me and texting me and saying, hey, are you okay from the hurricane? And we got quite a bit of tropical weather here about 2 nights ago, or actually it was not last night, yeah, so 2 nights ago, and had lots of rain, lots of wind, and thankfully no trees were knocked down near our house, and so we didn't lose power or anything like that. But there definitely were several parts of our town that did lose power, and that right now are still without power. So they're working on restoring that. And we didn't get hit nearly as bad as some of the other areas as well. So I got Chase coming on the Facebook live feed there from Boise, Idaho, and I have Caleb Bryant from Nashville saying the sound is good. That's awesome. Thank you so much for joining us. And this is going to be a little bit shorter than our prior webinars that we've done. I don't think that we're going to need to spend too much time going through a lot of this stuff, but there's been a lot of confusion, as I'm going to seminars and meeting with people and networking, there's been quite a few people that have had some confusions as to, what is a KP, that key principle, and what is a sponsor, and what is maybe a loan guarantor, and trying to dissect all of those. So we're going to try to cover everything we can today in about probably 15 to 20 minutes, give or take a few. And then as we're going throughout, you guys will most likely have some questions. And so if you're on Facebook, you can type in some of the questions. I'd prefer on Facebook, if you have a question, to just do it at the end so that all the questions are kind of together. And then, because I will answer them at the end. And then if you're on our Zoom platform, inside of the Zoom platform, there is a Q&A section under the bar that says Q&A. It's like a little box that'll pop up. And there's a place there for you to put in your questions. And that way they're all in one little section there, so I can go through at the end and answer all those questions that I might have for you. So, or that you may have for me. So thank you everybody for joining us. We have, like I said earlier, as you're joining us, please go ahead, and if you're on Facebook or if you're on the Zoom platform, go ahead and type in the comments or on the chat box where you're located, where you're calling from, and if you're on the Zoom platform, change the to field from all panelists to all panelists and attendees so everybody can see. So welcome to the platform. I'm running the show all by myself today. So usually Brandon, my partner, is with me, and he had another project that he had to go do at this time, so he was not able to join me. But we also have Scott Morongle that came in that's on with us right now from New Jersey. Welcome, Scott. And so he won't be with us, so you'll probably see my head bopping back and forth because I have a large screen here in front of me, and then I have my laptop, which has to the right of it, that has the PowerPoint on it. So I'll kind of be bouncing back and forth, making sure I get your comments and your questions. I got Kurt on here from New Jersey as well. And so again, as you're joining us, type into the chat box or the comment box and just tell us where you're from. And then I got Kevin on here, DC. He's in the building. Awesome. Thanks, Kevin, for joining us. One of the reasons why I like doing it where, we can all be participating and, all this is because a lot of times people will, say, oh, it's just a recording. And yes, we are recording this, and in the future, we'll, if you've registered for this webinar, you'll get a copy of the recording. So if you're on Facebook and you haven't registered for the webinar, there is a link in the description on the post for the webinar where you can go and register. That way you get a copy of the webinar when we're done. So you can do that right now and still continue to watch it on Facebook if you choose. So we're going to go ahead and get started. So I know a lot of you are, probably taking maybe 30 minutes away from work or from what you're currently doing just to kind of focus on this. And so I want to go ahead and dive into it. And for those of us that, for those that are joining us a little bit later, we can do that a little bit later. I can send you the copy of the recording. So first off, my story. So I don't want this to take too much time. And so we're going to spend about, like I said, 15, 20 minutes going through this material, going through it pretty quickly. And as most of you know, as you follow me in the past, I do talk really fast. And so I can't slow down. It's just not in me. So I don't want to be somebody that I'm not. Welcome, Whitney. Welcome, Latoya. Whitney's coming in from Roanoke, Virginia. Latoya's from Northern Virginia. And we have Carlos from Portland, Oregon. So we got coast to coast. And we got Whitney Ward from Atlanta, Georgia. And then we have Lee from Houston, Texas. So we also have John Jacobus from Carmel, California, and Lynn from Boise, Idaho. So we're all over the country. Thank you guys for joining us. Thank you for letting me know where you are. It helps me kind of place where everybody is and lets everybody else know that where everybody is on the webinar too. So my wife and I have a podcast called Tough Decisions for Entrepreneurs. And it's a daily podcast, and every single day we're on there posting and releasing content. So as real estate investors, we are entrepreneurs. And so it would be crucial for you to, go ahead and just subscribe to that on iTunes. You can do it on iTunes or the Android platform, wherever you normally get your podcasts. Go ahead and just pull out your phone and type in Tough Decisions for Entrepreneurs and subscribe to it. It's very valuable. And for those of you who are listening and have ever listened to our podcast, I'd love for you to share some comments about it so that others who are watching right now can kind of know that there actually are other people listening to it and some of the feedback that we have. So we really appreciate everybody who's joined us. But our story is on the Tough Decisions for Entrepreneurs podcast website. And you can actually go to toughdecisions.net. That's toughdecisions.net, and find at the very top of the page, there's a link that says Our Story. And so if you go to toughdecisions.net and you type in Our Story, it's my wife and I dialoguing back and forth about my background and what we're doing and various things like that. So I want you to get to know us a little bit more, but I don't want to take this time on the webinar to do it either. So hopefully I got someone from Charlotte, North Carolina, got Joe Eli, and then Dakari Towns from Columbia, South Carolina, right where I am right now. So shout out to Dakari for being on with us from Columbia. We got Eric from Denver, and Mitch from Boston, Jeffrey Gow from New York City, and I got looks like maybe Perry from New York City as well. So we got lots of people on us from all over the country. So let's go ahead and dive into this topic about what is a key principal or sponsor, and then we'll also get into the loan guarantor piece as well. Got JT joining us from Fort Mill, South Carolina. Thank you for joining us. And as you guys join and you come in, go ahead and let us know where you're on the chat box or in the comments on Facebook. Let us know where you're tuning in from, and obviously your name shows up. So just type in where you're coming from. That way everybody kind of knows. And then I also would like it is if you're on Facebook, go ahead and just like the video, things like that. It helps kind of increase the promotions and things like that on it. Just really helps us out, get the word out a little bit more. So if you're on there and you can just press like or love or whatever it is on there that you guys do, that'd be great. And so what is a key principal? So let's stop for just a minute, and I want to talk about what is a sponsor and what is a principal. So a principal, not key principal. So a principal or a sponsor is somebody in a syndication who is putting the deal together. They're finding the deal, they're acquiring the deal, they're doing the due diligence, they're doing the asset management. They're basically putting the deal together for the LPs, those limited partners. Those are your investors. Those are your passive investors. That is what would be called a principal. I actually just saw that I misspelled the PowerPoint. So for those of you who are wondering, that's not how you spell the principal we're talking about. That's like a principal in a high school. So I did catch that there. So I'll fix that in a future slide. So the key principal or the sponsor is you. So if you are putting together a deal, you're finding the deal, you're acquiring it, all of that, you are that principal and you are that sponsor. So both principal and sponsor are synonymous. So don't get those confused. If you say, I'm a principal, then you're also a sponsor. Now, what is a co-sponsor? Well, a co-sponsor is kind of the same thing. It's just you have more than one person in the group. So if you have 2 or 3 people that are joining together to be sponsors, you guys would be considered co-sponsors. Just like if you were founding a new company and you would become the founder of that company, if you had 2 or 3 founders, you'd be co-founders of that company. So it works the same way. But both principal and sponsor are synonymous. Now, let's talk about the key principal. The key principal is a little bit different. So the key principal is also synonymous with loan guarantor. So most of the time that key principal is guaranteeing the loan. And so if you say, you need a loan guarantor, you're pretty much saying you need a key principal. That key principal is the person that allows you to be able to get the loan for that deal. If you don't have that key principal, then you can't get the loan. You have to have enough things. And we're going to go through some of the requirements as we go through this webinar of what you need for a non-recourse Fannie Mae or Freddie Mac loan. There's 3 requirements, and we're going to go through each one of those things so that you know exactly what you're looking for. Now, the next slide here, let me pull up. So the next question is, do you need a KP or a key principal or a loan guarantor? So a key principal, again, is synonymous with loan guarantor. So as we go throughout the rest of the PowerPoint, you'll see me using KP or key principal synonymously with loan guarantor. So yes, in most situations, you will likely need a loan guarantor if you don't meet some of the requirements to receive a non-recourse loan. Now, if you meet these requirements, you may not need one. And in some situations, even though you meet the requirements, it might be a good idea to bring somebody on to bolster the general partnership of a deal to be able to get you some better terms. So we'll talk about that. So the next thing here is the non-recourse loan. So in the non-recourse loan, there's 3 requirements that you have to have in order to get this loan. Number 1, you have to have net worth of the value or the balance of the loan. So it's not net worth of the total amount of the purchase price, it's the balance of the loan. So if you have a $10 million property that you're trying to purchase and they do 75% LTV, then you're going to have somebody on your team that has a net worth minimum of $7.5 million. Now, the second requirement is liquidity. The liquidity requirements is 10% of the loan balance. So if in that same scenario, you would have a $10 million purchase price, 75% LTV, you're at $7.5 million loan balance. You're going to need 10% of that, so $750,000 in liquid assets. That means it has to be in some sort of stocks. Some lenders don't mind if they're in bonds. They have to be some sort of liquid assets. You have to be able to access them whenever you need them. And obviously, liquid meaning cash, so you can be in a savings account, checking account, money market, anything that you can be that is a marketable security or any way you can get access to that cash right away. And the reasons why they want those 2 things is they want to make sure that you have the ability to help the deal if it starts to go south. Now, that doesn't necessarily always happen, but that is what they want. They want you to be able to step in and help if at all possible. Now, when that particular situation happens, then there is also going to be some dilution of some of the shares of the partnership, because if you're going to have somebody put in additional money, and not do a capital call, then there's going to have to be some additional spread on that. Now, the third requirement is experience, and experience can be twofold. Number 1, it can be experience, which is what everybody thinks about, is experience managing assets the size of the asset that you're trying to purchase, or at least somewhere around there. Now, they also look at your background. Like, for example, in my background, I have an entrepreneur background. And so I have 5 medical offices that I've run in South Carolina, as well as a couple other businesses that I run that are online businesses. And so I have a large budget that I'm managing on an annual basis. And so they take that into account as well, as far as your experience of managing a large budget, but also your experience in managing and managing the units that you're going to be buying. Now, you're definitely going to have a property management company with you when you're doing larger assets, but even if you're doing smaller assets and you may be self-managing it, you need to have somebody on your team that has experience managing apartment units. And so if this is your first deal, you want to make sure you bolster your GP and bring somebody on that has that. So that's one of the things you want to look for when you're looking for that loan guarantors. Do they have the net worth to meet the requirements? Do they have the liquidity to meet the requirements, and do they have the experience? Now, let's say you meet all of those requirements. Well, what that means is that you might want to go back to the lender and say, hey, if I bring this other loan guarantor onto my deal, can I get better terms? Now, they're not usually going to be able to push proceeds and give you more. They're not going to be able to increase what they can give you, but because most of the time in that situation, they're constrained by the requirements of the DSCR and the cash flows of the property. But they may be able to give you more interest only, and they also may be able to give you more, a better rate. So we recently, my group recently put together a deal where I was able to jump on as the loan guarantor, and we got 6 years IO on the deal and a really good rate on it too. So just keep that in mind. Don't always think, oh, I don't want to bring anybody else on because, I want to keep it all for myself. Because you could probably get better returns. You would get better returns for your investors as well as yourself if you're able to bolster that GP and bring somebody alongside you. And keep in mind that we're going to go through in a few minutes here on what are some of the fees that a loan guarantor may charge to be able to jump on the GP. And those things can change based on what other partners in the GP bring to the table, and that they're not, if that GP or that loan guarantor is not bringing the entire balance sheet, if you will, to the table. The next thing here is going to be, people always, will ask, they'll say, well, what about non-recourse loans? So this is going to be a non-recourse loan. So why would I give you any piece of the GP or anything like that? If there's no risk for you, why does it matter? Well, in a non-recourse loan, there are carve-outs for what are called bad boy carve-outs, which means any type of illegal activity that happens in the partnership, that person can become liable for that and it turns from non-recourse to recourse because of that. And so when a loan guarantor is looking for a sponsor to go in and become their key principal or their loan guarantor, they want to build relationships with them. They want to have, some sort of, they want to be able to know, like, and trust them. Just like we talked about on another webinar about raising private capital and how investors want to know, like, and trust you in order to invest with you. It's the same thing with this. If there's a loan guarantor that wants to do work with you, they want to know, like, and trust you. They're not just going to meet you one time and then never talk to you until you have a deal. They want to have that constant and open communication with you, that open dialogue, so that they can build that relationship and feel more comfortable with you. And then the other risks are, if for some reason the deal falls through and there's no illegal activity and we have to basically just turn in the keys on a deal, that loan guarantor gets a black mark on them with the a stamp on your at Fannie Mae or Freddie Mac saying, no, you can't do this anymore. And so they prevent you from getting any loans. Now, it's not a permanent, you can't ever do it again, but it does prevent you and make it a little bit harder for a loan guarantor to continue to get loans and guarantee other loans when they have another deal in the pot that had to be turned away. So there's several different nuances there, and I'm glad to dive into that, offline a little bit more. But there are some risks involved with it, and you want to make sure that you are cognizant of that and not just flippant about it when you're trying to talk to other loan guarantors or KPs, because the risks are definitely real, and you want to make sure you're paying attention for them. All right, so selecting the KP. So we have talked about obviously making sure that they meet the 3 requirements for the non-recourse loan. But one of the other things you want to do is you want to make sure that you have a KP that, number one, is willing to jump in and step in when needed, but also one that's going to allow you to implement your business plan the way you constructed it. Because some loan guarantors can be a little bit more hovering over the deal, and want to have a little bit more in the decision-making process, and really kind of butt heads with the sponsor, and it can cause a lot of conflict. And that right there can make a deal go south. So you definitely want to make sure that the sponsor, the key principal, is comfortable with you, and they're comfortable with it. And you're always communicating with them and providing them with monthly updates and providing them with the monthly spreadsheet so they can keep an eye on things. And then if there's any issues, you want that person to be able to help out if needed, and be able to figure out what's the best avenue or best option when it comes to moving forward. So just keep those things in mind as well. Now, the biggest question here is, how do you find a key principal or that loan guarantor for your deal? One of the best ways you can find a key principal or a loan guarantor is to be out networking at events. Because at events is where you're going to probably find people who are in this space and who are more comfortable with doing these types of loans. Now, I will give you a disclaimer and say I am a KP on some deals, and I also am a loan guarantor. So I am an option and a resource for you. But again, at the same time, I want to build a relationship with you before I just sign on a loan or anything like that. So I do have the ability to do that with you, and we can talk about some of the requirements as far as how much we're able to do off the webinar, on a phone call if you'd like. At the end, I'll give you my cell phone number, and if that's something you're interested in, we can jump on a phone call, and then maybe one of these days we can meet up to be able to feel more comfortable with each other. And then so the biggest way to find these people is to be out networking and talking to other syndicators, because there's probably another syndicator out there that's had to get a loan guarantor and they have somebody. I know some coaching groups also have them within the group, but I also know some coaching groups that don't offer that as a service, and so there's no option there for you. So just keep that in mind, that you always want to be keeping your eyes out for that and building relationships with people that could possibly be that KP or loan guarantor. Now, what does a typical KP cost the GP, that general partnership? So I was at a seminar this past weekend in Nashville, and several of you that are on here were at that event. And I spoke to many of you, and the consensus that I found at that event, as well as other people, is typically about 20% of the GP is what a KP or a loan guarantor will want to have in order to take that risk and allowing you to take down that project. And they also have a guarantor fee on top of that that's paid at closing of 0.5% of the loan balance, or $50,000, whichever one is greater. And it's the loan balance, not the overall purchase price. So those are the typical and standard fees. And just to give you an idea of what I typically charge when I'm a KP or a loan guarantor, is I have a kind of a tiered system, and it's not. I'm going out and doing deals myself, and so I know how much hard work you guys put into finding a deal, acquiring the deal, doing the due diligence, and putting a lot of your work into it. So I don't really feel like I want to take that full 20%, and so I have a tiered approach. So if the loan to balance is less than $10 million, then I do at 15% of the GP. If it's greater than $10 million, then I do 10% of the GP. Now I also have the guarantor fee, but it's in half. So it's a quarter point of the loan balance, or $25,000, whichever is greater. That's paid upon closing. So those are the different spreads and different things like that when it comes to the what it costs you to be a key principal or to bring a key principal or a loan guarantor on top of your deal. Now, this next slide is all about questions. So I know there's already a couple of questions that have come through, and as you are going through. As you're listening and you had questions, go ahead on Facebook, type in your questions if you have them. If you're on the Zoom platform, go on to the bar at the bottom there, and it says Q&A. And then this is my cell phone number on the screen right now. So if you're interested in wanting to jump on a phone call with me, discuss this a little bit further, have any questions offline that you want to talk to me about, I don't want you to call me. I would rather you text me first, and that way we can schedule a time to get on a phone call to discuss a few things. So just send me a text message and give me your name and your email address, and then tell me where you're from, and then we'll schedule a time to jump on a phone call and discuss anything further. And look forward to meeting as many of you as possible offline. And I travel quite a bit, so if you follow our Multifamily Investor Nation Facebook page, you will see that I travel quite a bit. And when I'm in your area, I'll try to put up some sort of a meetup, and we can get together and maybe have a cup of coffee or go to lunch or whatever the case may be. Or if you have a property that you're looking at, I don't mind flying out to the property and taking a look at it. As long as you're interested in having me as that KP or loan guarantor. So anyway, that's my cell phone number. Jot it down. Even if you don't want to call me now or anything like that, go ahead and do that as well. So here's a couple questions. So the first question that came through here was from Vineet, and he asked, are funds available in a HELOC considered liquid? So the consensus here from the lenders that I've spoke to about the HELOCs and allowing that to be liquid is you can put a HELOC on your house, and just typically the HELOCs are available on a primary residence. So you can put a HELOC on it, and whenever you need to meet liquidity requirements, you can pull that money out for that one-day snapshot to show that you have the liquid assets. The only thing you want to keep in mind, though, is that let's say you have $1 million house and you put and it's all paid off. Let's just say it's all paid off, and you put a HELOC on there. They'll typically do about 80%, 75 to 80% of the value of the property. So you have about $750,000 to $800,000 that you could pull out to meet that liquidity requirement. You can pull it out, but whatever amount you pull out also decreases your net worth by that same amount, because now you're actually creating a liability and pulling out an asset. So you have that cash balance, but you also have the negative balance for the net worth. So as long as it doesn't affect the net worth, and you can still take the loan down with that, then you can then most lenders will allow you to pull it out of a HELOC to show that it is liquid. And then once you close on the property, you can put that back on your HELOC if you choose as well. You don't have to keep it out for the entire amount. So no more questions that I see coming through on Facebook. So if you're on Facebook and you have any questions, jump in there and do that. I do have a couple of questions that have come through on the link, the Zoom platform. And so Latoya is asking, do you actually need to get a loan? Couldn't you just raise the funds needed? So the answer to this question is yes. And in some situations, depending on the type of property, you may have to raise all of the funds. But one of the things that we always look at when we're trying to look at purchase a property is getting the best returns for our investors. And so if you're trying to raise all of the money for a deal, it depends on what your plan is for that property, because it will in most cases significantly reduce your IRR, that internal rate of return that determines what the return on the investment is for the investors. And so you always want to keep that in mind and run the modeling on it. But in some situations, if it's a property that just can't get a loan, then you might have the only option to do is to raise all of the money for it. But if you look at the numbers and it's a stable asset, most situations it's better to get a loan on it, especially because right now usually you can get a couple of years of interest only, and that just helps the cash flows, especially during a renovation process in the very beginning. So good question there. And the next question is, can you have more than one KP? And the answer to this is yes. So if you have, let's say you're trying to take down a $20 million loan balance on a property, and you have 3 people on the deal. One has $5 million net worth, another one has 10 million, and the other one has 5 million. You can use and aggregate all of those KPs together to bolster and build up the net worth. So the net worth requirements, and those 3 requirements, are based on the entire stack of the GP. So as long as everybody in the GP stack together meets those requirements, then yes, you can use more than one P. So good question there, Carlos. Let's see, what other questions do we have? Okay, so Kenneth is asking that, is he's saying, hey, I'm interested in discussing with you about KPing or being a loan guarantor on some of our deals, but basically he's asking, would you be able to bring any capital to the table? And the question to that is, depends. So as a loan guarantor and a KP, my biggest requirement to be able to jump on somebody's deal is to make sure that the debt is going to be paid. I don't necessarily have to make sure that there's certain return requirements for investors, because your investors might have different return requirements than my investors and my network. So even though I might not bring investors to a deal, I would still KP or be a loan guarantor for somebody. But if you have a deal that's really solid and you need some capital, then I am definitely open to talking to you and bringing some capital from our investor base as well. So I have a wide network of investors, and we can raise quite a bit of money. So we can definitely talk about that, Kenneth. That's a great question. All right, let's see. Any other questions coming through? I don't have any other questions coming through. The timing was perfect on this one. We are right at about 10:26. I told you about 15 to 20 minutes, 30 minutes tops. And so I have another question that came in from John out of Alabama. I know where he is from. It says, how hard is it to find a KP that understands new construction built from the ground up apartment complex? So this KP and loan requirement is typically across the board, no matter what asset that you're doing for non-recourse. And so, I'm also a KP or loan guarantor for other types of assets. So if all you need is someone to jump on and understand the project and understand the risks involved, then, and you can do a non-recourse debt, it shouldn't be that hard to get somebody to jump over to a different type of asset class. Like, for example, I was talking to Chris out of Charlotte, Chris Bennett out of Charlotte yesterday, and he said that even some self-storage loans you can do non-recourse on. And so it's a little bit harder in that space, but you can definitely do it. And then, of course, in the commercial space and stuff like that, there's other options for that. So hopefully this content was very helpful to you. I appreciate you guys jumping on at a 10 o'clock on a Friday morning. Thank you for all the questions. If you have any afterwards, shoot me a message, let me know. And thank you guys for joining us. And hopefully, as you're leaving, you can basically make a comment on Facebook or whatever about this webinar and post a review about it or whatever. And again, send me a message if I can help in any other way. And look forward to having another webinar in the next couple of weeks or so.